So yeah, and just like the other iterations we've had recently, um, I do prefer it to be more question driven. So don't hesitate if you have any questions, even if you think it's a dumb question or a question about something we've gone over 3 times, 4 times, or 10 times. Um, my goal is that everybody fully understands the things we're going to be going over today. Today's topic is advanced options trading, stock options 101. Part three, we're going to be going over debit spreads, and then we're going to go into an in-depth Q&A portion of the session. But before we do any of that, um, before we do any of that, I want to go over a quick recap, which is also going to be question led. So before we get into the rest of this session, is there anything you guys are still shaky about when it comes to options? We're going to dedicate maybe 10, 15 minutes to answering any questions you guys have about things we've already gone over in the last 2 parts of this series. All right, so right now, no one is has to be muted or anything. But if it becomes an issue where we can't hear, um, then we'll probably go back to that. So, um, any volunteers? My battery level is low. Oh man, you're right. Thanks, Victor. All right, so yeah, anybody have questions regarding things we've gone over the last 2 sessions? And if you're not sure what we've gone over the last 2 sessions, here is a brief overview. Um, so the first part, we went over buying calls, buying options. We went over the basics of premium, right? Talking about the things that cause an option contract's value to fluctuate, whether it be up or down in relation to the movement of the underlying stocks price action. We've talked about the difference between trading and investing and the basics of finding a good options trade or investment. Then part two, we we went into some of the differences between in the money and out of the money, right? And in what situations one might consider buying an options contract out of the money, vice in the money, and vice versa, and how there are differences in risk, profit, um, position sizing, and all these different factors that go into play when it comes in to determining whether or not you're going to buy something in the money or out of the money. And a lot of that revolved around the concept of intrinsic and extrinsic value, right? And a lot of that built on some of the stuff we went over in the session prior to that, which again was the basics of premium, right? Um, what else did we go over? We also talked about leaps and covered calls. And when we talked about covered calls, we talked about naked calls. And then we had a Q&A. So those are some of the things that we will be building on today. So I do want to give you guys a chance to kind of raise any questions about the things we've gone over in the past. Because if you're still shaky to a significant extent, then today's session might be a little difficult to grasp if you're not familiar with debit call spreads at all. So, any volunteers? Anybody have any questions? Feel free to unmute and voice your questions or write it in the chat. Can everybody hear me? Okay, awesome. All right, so sounds like we have no questions. All right, so let's just go ahead and get into it. All right, so debit spreads. All right, does anybody here have any experience with trading debit spreads, and would like to let us know what you know about debit spreads so far? How's it going, Cardio Rudy? I'm sorry I didn't catch that. No. Okay. Do you know what they are? Do you have a like an idea of what they are? Fairly new options. Okay. Mm-hmm. Is everybody else is everybody else in that same level of experience where they're not really familiar with debit spreads? If so, we could just write yes in the chat, and then that'll give me an idea of how in depth I need to go over certain things. Okay, that makes sense. And thanks for the participation, guys. That's gonna make this session go by a lot easier because I'm gonna know what things to focus on when because the thing I want to avoid is you guys leaving the session and not knowing what the heck was discussed. So with that being said, I want to revisit a few topics before we go into call spreads, debit spreads. All right, so some of the basics of options. Again, we're going to go over a quick recap. So, an options contract is a derivative investment that gives the owner of the contract the right to buy or sell a specified number of shares of a stock, ETF, or another predetermined underlying stock at a certain price before a date. So, in a sense, when you buy an options contract for something, you're not buying the stock. But if you're buying a call option for a stock, you're essentially buying the right to buy that stock at a future date for a future price, right? Whereas if you're buying a put option for a stock, you're not selling or buying a stock, you're simply buying the right to sell a stock at a set price by a future date, right? And then the reverse of that is that you can sell a call option and you can also sell a put option, right? So, and when you sell a call option, um, you're not buying the right to buy the stock at a future um, price, at a future date, at a predetermined price. You're you're essentially on the other side of that, and you're essentially selling somebody an options contract that gives them to buy a predetermined amount of stocks at a predetermined price by a predetermined date, right? And if certain circumstances are met, they can exercise that right to buy those options from you, and you, I'm sorry, to buy those shares from you, and you have to provide those shares, right? Um, so if you're new, you probably got lost there. So let's go back a little bit. Let's talk about down here. Do 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 do. The reason why I'm going over this part is because we're going to talk about a debit card spread, and a debit card spread is composed of two actions. One is buying a call option, right? And the other option, I'm sorry, and the other part is selling a call option, right? So in previous sessions, we discussed Scenarios surrounding someone buying a call option, which gives you the right to buy a certain 100 shares at a predetermined price by a predetermined date. And then we also discussed separately selling a call option, right? When I say selling a call option, that's when we are talking about covered calls, covered and naked calls, right? And when we were talking about selling calls, covered and naked calls, we talked about the big difference between covered and naked calls is that in one scenario, covered, you're selling an option to someone for shares that you already own. So in the event they exercise the option that they bought from you, you already have the shares that you would need to provide them. So in a sense, the transaction is covered. Whereas with naked calls, you're still selling a call. However, in the event the buyer of your call decides to exercise that right to buy 100 shares from you, you wouldn't have the shares to give them. So in that scenario, you would have to buy those 100 shares to immediately sell it to the exerciser of the option that you sold them, right? So one, the transaction is covered because you already have the shares, right? In the other scenario, the transaction is not covered, so you would then have to buy the shares at whatever price the market has it at to provide the 100 shares to the buyer of your call, right? So, anybody have any questions about selling a call option? Like what the difference is between buying and selling a call option? Because this is going to be a really important point we want to get across before we start talking about debit call spreads more in depthly, right? So, anybody have any more questions? Does everybody understand the difference between buying and selling a call? Does anybody not understand the difference between buying and selling a call? Come on, guys, we got to get some participation. Okay, awesome. So, all right, pop quiz. Cardio Rudy, what's the difference between buying and selling a call option? Buying and selling a call option. Yep, yep. Awesome, awesome, and that's exactly what I'm looking for. Just to make sure you guys are actually grasping it. All right, so cool. So yeah, let's go ahead and move on. Let's see. All right, so calls versus puts. Right. So we talked about debit call spread briefly. Right. And now we can talk about debit put spreads, and then we'll go into some scenarios to kind of discuss the differences in risk versus profit, position sizing, etc. All right. But debit put spread. All right. Cardio Rudy, are you still there? All right. So, yep. So debit put spread, right? So if you understand this, which sounds like you do, You want to give this a shot explaining what a debit put spread consists of? Say that again. So that's close. You just got to change one word in that sentence. All right. So if you can see what I'm typing, so it's not buying or selling puts. It's doing both. All right. So you pretty much had it, but it's not or. It's doing both. However, so all right. So let's say you're buying a put, right? We all know that if you're buying a put, you're essentially buying a right to sell shares at a certain price by a certain expiration date. But when you're selling a put, what are you doing? No, no, you're doing well. Anybody? Hmm. Hmm. All right, so let me help you out, right? I'm gonna help you out by asking you a question, and this might help you figure out where the differences lie. All right, so if you're buying a put, typically you would say that's bearish or bullish. Bearish, right? Correct. Right? If you're selling a put, would you say that's bullish or bearish? Typically. Hmm. Right. Yeah. So, um, a popular technique you'll hear when it comes to selling puts is something we call, just writing it down here, selling cash secured puts, right? And the opposite of that, just saying selling naked puts, right? Selling naked. Now, obviously, you're probably guessing, you probably already know which method would be the more risky. All right, but before we dive deeper into what a debit put spread is, um, we want to make sure you guys understand what selling a cash secured put is and what selling a naked put is. Because it sounds like we all understand the debit call spread to an extent, and we'll go in depth later. Um, but let's talk um, about this part of selling. I'm sorry about this part of buying a put spread. All right, so let's go to, where is my chart? All right, so somebody pick a stock. What's the stock we wanna look at? Say that again. Okay, XOM. Gotcha. All right, cool. All right, so let's see what kind of time frame I want to look at. Okay, so I got the max monthly, right? So if some of you guys aren't familiar with candlesticks, the way I have it set up, each of these candlesticks represents a month of time, right? A month of price action, right? So show like this, right? This is a month, this is a month, this is a month, right? So I'm gonna go ahead and back out. All right, so let me give you an example of why somebody like Warren Buffett may use selling cash secured puts whenever he's bullish about a stock, right? Or why somebody might sell cash secured puts to buy a stock that they're bullish on, potentially for a better price than what it's selling at now, right? All right, so let's say I want to put in I want to enter a large position into Exxon, right? And let's say eventually I think that it's going to not only get back to all-time highs, but exceed all-time highs and continue to um, to increase in value. However, although I think this will happen in the long term, let's say I believe that before it continues this strong rally, I expect a dip, right? And let's say I'm not, exactly sure it's going to dip, but it's very likely. I think it's very likely it's going to dip. And let's say I'm looking into the technical analysis, and I come up with a price point that I expected to dip to, and then bounce and continue its rally. Let's say the support that I identify is right around here, right? 59.17, right? So I'm gonna put a marker here, all right? Okay, I'm gonna label this. I'm gonna make sure it's up. 17. All right. So, and why would I pick this level? Well, there is some volume around these levels. As you see, a lot of people bought it around these levels here, right? Back in between 2004 and 2006. And then again, you had a lot of people rushing to buy it in 2008, right? You see, it bounced right up. As soon as it touched these levels, it bounced right up. Big orders came through. Same thing happened here around 2010. We did, however, in 2020 see it break through that support like butter here, right? And brief relief bounce, drop further, and then bounce from way down here, right? And then consolidated again around 15, 17 for about a year or so, right? So we're saying, all right, I think this is going to go through the roof, but I expect it to dip again one more time to 59.17. Let's say that's what we're expecting. I'm not necessarily saying I expect that because I don't really follow this stock. Um, but let's say that's happening, right? So I want to get in, but I also want to be patient. And I'm thinking, if I can get 100 shares of this stock at the price of 59.17, right? How much would that cost me, right? It cost me $5,917, right? Whereas if I bought 100 shares of it at current prices, right now it's selling for $84 9 cents. It would cost me 8,409 cents, right? So you got a difference of $2 or $3,000, right? Um, so what if there was a way for me to enter this trade potentially, all right, when the price is at a more reasonable level, and I'm not going to know how long it's going to take to meet that reasonable level, but let's say I can wait and get paid to wait. That would be pretty ideal, right? So that's what cash secured puts offer you. Um, so how would this look, right? So right now it's at 84.09, right? So if I was to buy a put at, let's say $60 or so, where's $60? Let me see. Uh, can barely see it in this color. So I'm gonna pick an arbitrary number, like 65. Why not? All right, and then I'm gonna extend this to the left. All right, so let's say I bought a put at $65. Well, if I was buying this put, that would demonstrate that I'm probably bearish. Um, and if it dropped below 65, let's say it dropped even lower and lower and just tanked, no matter how low it went, I would retain the right to sell my shares at $65 a share, right? And that's if I had shares. Let's say I was just buying a put so that I can buy it for one price and then sell it for another price. And let's say at this point, the price of the $65 put, strike price of $65, let's say the price of that was like 10 cents if it had an expiration date, a month out, right? Let's say it costs 10 cents, but then this stock tanks way below 65, each option that I bought would probably be worth thousands of percent more, depending on how much it dropped, right? Now, what about the person on the other side of that transaction, right? So the person that I paid 10 cents to for each contract, right? Well, they would have received that 10 cent per contract, right? And there's a few scenarios where the action would be different, right? So they would receive that money up front, that 10 cent per contract, right? And if a month later, when the contract expires, if the price of Exxon is higher or where it is right now, or lower but not lower than $65, what would happen? Well, nothing really would happen, right? As far as the seller of that put would go, right? I would be able to buy shares at a lower price, but I wouldn't have to buy shares yet, right? However, let's say if the stock um, goes lower. Oh wow, I seen somebody's video. How do I move this? Cardio Rudy. So man. Um. So yeah. So let's say the stock dropped below $65, right? Well, in that case, I would have to buy those shares at $65 a share, right? Because again, the buyer of that put, they get the right to sell those shares at $65 a share, but they can't exercise that right unless somebody actually buys those shares from them, right? So when you're selling a put, in a sense, you're putting yourself in a situation where you get paid up front. However, if the buyer of your put exercises that put, you are obligated to buy 100 shares per contract from that put um, buyer, if that makes sense, right? So that's a big difference because a lot of times when we talk about calls and buying calls, we talk about, you're buying a right, but not the obligation to buy shares at a predetermined price by a predetermined date. But when you're selling a put, you are getting paid up front premium. However, in the event the option is exercised, you are obligated to buy those shares, right? Now, in one sense, you could say you're obligated. In another, frame it in another way, you could say you get to buy, right? And it all depends on if you wanted to own this stock anyways, right? Let's say you're Warren Buffett and you want a huge position. You want to allocate 5% of your fund into Exxon, right? And again, you think it's going to go up through the roof long term, but you think it's going to dip, right? You could put all your money in it right now and it could potentially dip. You'll take a little hit in unrealized gains, or you can sell a ton of puts, right? Make a few $1 million in premium, right? And excuse me. And one of the worst case scenarios is it keeps on going higher, right? And you haven't had your chance to buy your large position. But I mean, you still keep that premium that you made, all right? Or, right, it does drop lower as you expected. You keep that premium that you made in the beginning, right? So you're not losing any money, right? And then it drops down to $65, and now you don't see it as being obligated to buy shares. You see it as, oh, great, now I get to buy shares of Exxon at $65. I'm glad I waited and didn't put in these millions of dollars, billions of dollars into it when it was at $84 a share, right? So, in a sense, the transaction is covered the way selling calls would be covered if you choose to trade it that way. But the term is called cash secured. All right. And the reason why it's cash secured is, let's say you're the seller of that put, right? From the jump, and you're receiving that premium, you're getting paid, right? At that moment, you have to lock up a certain amount of money that you can't touch until the expiration of that until the expiration date of that contract has expired, right? Now, what happens with that money depends on how what the price action is, right? The better question is, how much money would you have to lock up for the duration of that option contract, right? It would be exactly the amount of money you would need if you were in a position to buy the shares at $65 a share, right? So in this case, right, you're selling that put, you would get paid up front, right? And the amount of money you would have to lock up for however whatever the duration is of that call of that put, right, would equate to how much? Equate to $6,500, right? Because that's how much you would need to buy 100 shares for each contract, right? So the other side of that, of course, is selling naked puts, right? If you're selling naked puts, you're not locking up any money, right? So in the event this happens, you would need to have that money in your portfolio, and if you don't have that amount of cash, then that can be pretty bad, because essentially the brokerage is lending you that money, and they don't really. Most of you guys don't have to worry about even doing that because a lot of these brokerages won't give you the opportunity to do that. Um, so we won't really go too in depth into naked puts. But before we move on and talk about what happens when you combine buying a put and selling a put, does anybody have questions with what the difference is between buying a put and selling a put? Yeah, definitely more confusing. What would you say if just pop quiz? What's the difference between buying and selling a put option? Hmm. Yeah. Sorry. So yeah, I mean that's the gist of it. What was that? Keep going. Keep- Yeah. Yeah. If you're not approved for selling naked puts, then yep. Exactly. Yep. If you don't have that money in your account, it'd be a bad situation. Hmm. Yeah. If you don't want to own the stock, then you wanted to keep going up. Yeah. So you could close out. So yeah, let's say I didn't want to own the stock, right? But let's say I thought it was going to go up and it wasn't going to dip. No, no, because if you buy a put option, you're not buying the right to buy the shares at a lower price. You're buying the right to sell the shares at a lower price. You know what I'm saying? Hmm. You know what I'm saying? Yeah, because if you buy a put, um, you're buying the right to sell the shares. But if you're selling a put, you're essentially getting paid for selling that put, and a few things can happen. If the price continues going up, right? You keep that money you got paid up front regardless, right? And there's no, yeah, you keep the premium from up front, right? But at expiration, if it's higher than the strike price still, no further action is required, and the money that you locked up for that time period is freed up. Make sense? But let's say it drops a little lower, but doesn't go below 65. Same thing, right? You keep that premium that you got paid up front, and no further action is required at expiration if the price is still not below the strike price, right? So you made your money up front, and the money that you had locked up for that time period is freed up, and now you can go about your business, right? The next scenario, yep, and the next scenario is let's say it does drop down. Yep. Mm-hmm. Yep. Yeah. So essentially, just to make it even more simple, you sell, you sell that put, you get paid up front. If the price is higher than the strike price at expiration, then that $6,500 you had locked up that entire time is freed up, and you made your profits up front. So up front, you can do whatever you want with those profits. Um, by the time expiration date comes by, those profits you got up front, it might be worth more depending on what you do with it, if that makes sense. Um, but if it goes below 65 and it's below 65 at expiration, then now it's likely that the buyer of the put will exercise the right to sell those shares at $65, and you'll be there to buy those shares at $65, which could be a good thing or a bad thing depending on if you wanted to actually own those shares in the beginning. And let's say even if you buy them at 65, right? In a sense, you have more money to buy shares with anyways, because you were paid up front in premium. So you could take that money that you paid were paid up front, right, and you put it with your money that was locked up anyways, so that you could buy it in the event you needed to. And now you get more shares at a more reasonable price than what the market was offering you when you originally were showing interest in this stock. So, when it comes to profit potential, um, so obviously this method is, when it comes to risk, is on the lower end of risk, right? Obviously, right? It offers you it offers you more opportunities to be profitable, but the amount of profits you get is not going to be as substantial typically as it would be in successful trades where you're, trading more risky strategies, right? The lower the risk, typically the lower the profit potential, and this is one of the lowest risk strategies, right? It's something people typically do for like a more consistent um, profit from options trading, right? Um, a few things that determine how much money you get paid up front from selling these puts. A big thing is going to be implied volatility, right? Which, for those of you who weren't here for part one, we'll go back to, I'm sorry, we'll go back to basics of premium. In this slide, we talked about implied volatility, which refers to the amount of an option's premium attributed to a stock's perceived riskiness. To put it another way, it estimates how much price movement is expected by the market in that stock before expiration. A stock that's more likely to make a big move in price up or down has more implied volatility, and a stock that's less likely to make a big move has less implied volatility. Higher implied volatility, or higher perceived riskiness for the seller of that option, equates to higher premium, right? Because if I'm selling you an option contract, whether it's a call or a put, for a stock that is very unpredictable and has very large swings, I'm going to have to charge you more because I have no idea what's going to happen between now and the expiration date. And I know that it could be a very large movement. So that increases the risk for me. And when you increase the risk, you increase the price. So what that means, right, is that going back here, if this stock is very, very volatile, then the seller of this put is going to have to charge for it. It's going to have to charge a lot more. So that can equate to higher profits depending on if the stock actually continues to be as volatile or not. But those are one of the things. That's one of the things that can determine how profitable it can actually be. It's how volatile it is. So I think it sounds like we understand um, what the difference is between selling a put and buying a put. It isn't one of the more popular ways of trading stocks, but once you start understanding what it actually is, it's easy to see the value in it, and it is one of the things that large investors do when they want to buy a stock. Is they're patient. They sell puts until they get it at a reasonable price. So let's go back to debit spreads, right? So far we talked about calls versus puts, right? Debit calls, debit call spreads, and debit put spreads, right? Now, instead of talking about the components that make up these spreads, let's put it all together and see what opportunity we're provided when we buy a call and sell a call at the same time. and where we buy a put and sell a put at the same time, right? So we're going to start very general and then we'll go more in detail. So let's say, try to think of a good analogy. All right, let's say I bought, oh, somebody's jumping in. All right, so again, let's go very generic. Let's try analogy. Hopefully this lands. All right, let's say, hey, Rudy, what's your favorite fruit? You still there? Cardio Rudy? Oh, I think he's taking a break. All right, so I'm just gonna pick for him. All right, let's say you buy an orange. Say it's expensive orange. Let's say you buy an orange for $1.50. Right? And let's say you sell an orange. So you sell an orange for, hold on, give me 1 second, guys. All right, yeah, sorry. All right, let's say you buy an orange for $1.50, and let's say you sell an orange at the very same time for $1, right? So what's the difference between both of these in price, right? The difference would be 50 cents, of course, right? All right, another scenario. Say you bought, let's go down to the puts. Let's say you bought a apple for, let's say you bought an apple for $2, right? Let's say you sell an apple, for $1.99, right? Difference would be 1 cent, right? So now, when we say we're buying an orange, of course, we're talking about buying a car. When we say we're selling an orange, of course, we're talking about selling a car. The same thing applies here, right? So let's say instead of single-handedly buying an orange, which will cost us $1.50, or let's say instead of single-handedly selling an orange for $1, we bought the spread. How much would buying a spread cost us? Right? And when I say I'm buying a spread, essentially what I'm saying is what if we did both of these things at the very same exact time, right? That will result in us only paying 50 cents, right? If both of these transactions happen at the same time, what comes out of our pocket is 50 cents because we're paying 150, but we're at the same time receiving $1. All right. So one of the things you notice is that trading these oranges in this way is more accessible than trading it by buying the orange alone. And what do I mean by more accessible? Well, think about something that's not very accessible for retail traders, right? As far as like a stock, that you're looking to buy. You think of something like Amazon, you think of something like what's another very expensive stock, like Google, like Tesla before the split, right? Well, now, I mean, now it's back up really expensive. So Tesla now, right? These are stocks that are very expensive, so they're not as accessible, right? Because if you want to buy into them, unless you're using fractional shares, buying one share of it is going to cost you a few $1,000s, right? So not very accessible, right? Same thing applies with the options for Amazon, right? The more expensive a stock is, the more expensive the options for that stock are, right? So depending on your expiration date, strike price, etc., you might find yourself in the same position if you're trying to trade an Amazon option as you would if you're trying to trade an Amazon stock. That it's expensive and you can't buy as many of it. And just getting in that transaction at all in that way would cause you to risk a substantial amount of money. So, in one sense, it's less accessible, right? All right. Whereas if you buy and sell that Amazon stock at the same time, or stock option, I'm sorry, at the same time, it costs you a fraction of the price to get into a transaction that involves Amazon options, right? Now, this is very, in my experience, this is very popular to use for very expensive stocks like Amazon, right? Let's say you think Amazon is going to go through the roof, but you just do not have enough money to profit off of this prediction because the stock is too expensive for you and the options are too expensive for you. Well, why not buy a spread for that transaction, which is essentially buying a call option for Amazon and selling a call option for Amazon at the exact same time. Well, you might find yourself with a spread that is very tight, right? And that offers you, say, buy an orange, Amazon, can't type today. All right, let's say the Amazon call is going for, do that. And say this is going for, all right. So let's say um, to buy that Amazon call will cost $3,000, right? Because you move the decimal two spaces to the right. And selling that Amazon call would net $2,900, $2,989. So what would be the spread between that? Well, it would just be the difference, which would equate to 11 cent, which would equate to $11 a spread, right? Because we're talking about options here, right? So again, let's say you think Amazon is going to go through the roof and you want to profit from this prediction, right? You've done a little studying on technical analysis. Now you're noticing patterns and you want to profit off of these patterns that you've, educated yourself on. And you want to get into this transaction, but you notice that all right, Amazon is very expensive, so you can't really afford to buy a stock, and the options for it are very expensive because the stock is very expensive, and you can't afford to buy an option, a buy a call option for Amazon neither, right? Because it will cost you $3,000. You don't have that, right? But you learn about debit call spreads, and you realize that if you do both of these transactions at the same time, it would only cost you $11 in order to get um, in order to get you a seat at the table, right? And that is much more accessible to a retail trader than the former, right? Now, let's say Money is not really an issue. Let's say you can afford to do either of these. Let's say you think Amazon is going to go through the roof, and you can afford to buy a few calls of Amazon, right, for 3,000 a pop. Let's say you can afford that. That doesn't mean you have to. Let's say you allocate $10,000 that you want to spend on potentially profiting on this prediction. You could buy, three Amazon calls, or you could buy as many Amazon call spreads as you can afford with that $10,000. And each of those spreads would only cost you what, $11. So how many spreads could you get? Well, you just take $10,000 divided by 11. You could afford about 900 spreads, right? Now, we haven't talked about the risk versus profit yet, but let's say Amazon does go through the roof in the time period that you're predicting it will, and the spread of these option calls goes through the roof, right? And let's say that profit potential goes up to like 1,000%, right? Which is essentially taking your $10,000, right, times it by 10, it's $100,000, right? So, what are the things that will cause a spread to increase in value? Well, it's very simple. If these go up in value, these go up in the spread goes up in value, right? Let's say that the price of that Amazon call goes up to like $5,000, right? Like $5,000, and the price of um, this call, which obviously these would be different strike prices, right? And we'll go into that. Let's say that goes up, and but it's about like 42, 43.50, right? Say, well, that would be 5 subtracted by 3, right? So now the difference would be $650, right? So if you took 650 and you divide that by 11, you have 59, right? So if you bought, let's say you bought, let's say you bought only one spread when these calls are going for this price, right? And next thing you know, the calls increase to these prices, right? The spread that you own will now be worth this much. So you would have purchased one spread for $11, and now that spread is worth $650. And imagine if you had purchased, 900 of these spreads. Obviously, the profit potential can be immense. It isn't always immense, but it can be immense, right? In this case, it would be 59 times, right, of your profit. So, before we move on from the debit call spreads, as far as what we've discussed so far, do y'all understand some of these basic principles and opportunities that are offered by combining both of these transactions? All right, because once you guys are, then we'll actually pull up a scenario and show how all of this really shakes out, and talk about the risk versus profit and how it's very much different than just doing one of these transactions alone. Let's see what we got here. All right, you guys got any questions about what we just went over? with the debit card spreads before we go more in depth. Anybody? All right, so we'll just move on. Let me see. All right, so let's draw up a scenario. Let's pull this one up. All right, so if you're not familiar with Thinkorswim, whenever you want to buy a trade, whenever you want to buy an option or sell an option, you go to trade, right? And you pick your expiration date. Let's pick something like 25 March 22. All right, then pick a strike price, of course. Um, so what's the price of this right now? Let's say we predict that it will retest all-time high by December 1st, 2022. So yeah, let's go ahead and change the expiration date. Actually, no, let's stick to a month out. Change the date. Actually, I'm gonna stick with Amazon. Okay, so let's look. We can choose 36, the arbitrary level. All right, so let's go to Amazon instead, and let's do 25 March. I'm gonna put a marker. Time level. All right, just to make it easier, let's try the end of April because we already got a marker there. All right, so let's say we want to see what would happen if Amazon hits $3,600 by the end of April, so essentially May. All right, I'm gonna put a little oval right here. All right, and then we're gonna find something around that time frame. So we got a 22 April one and 20 May. So let's just go with the 22 April one. All right, so again, we're going to pull up a scenario for buying a debit card spread. So this involves buying and selling a call option. And we think that Amazon is going to hit the $3,600 levels. So let's look around there. All right. So let's go down, 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 down. All right. So we have some strike prices around the levels we're talking about. All right. We don't have to actually choose these ones. We could, let's try to, because we think it's going to go to 3,600, but let's pick something slightly below. All right. So we have a strike price of 3,550. Right. And we got a strike price here of 3,560. Right. So a few things to notice. Right. This is quite a This is very out of the money for this time frame. So as you see, although these options are relatively expensive, um, they're not as expensive as they would be, at the money, right? Because we're buying an Amazon call at the money that expires on the 22nd of April. It's going to cost you, oh wow, yeah, so it's going to cost about 15 grand. Whereas these, since they're so far out of the money, they're still a little expensive, but they're much more affordable, right? So we're talking about the 33550. All right, so this one will cost a little under $700 if you wanted to buy this call option. If you wanted to buy this call option, it would cost a little under $600, right? All right, so let's say what if we chose to buy this call option, right? This 3550 strike price for $675. And let's say at this very exact same time we chose to sell this call option with a strike price of 3560, right? Well, two things you want to understand is that this one is slightly more in the money. This is slightly more closer to the money than this one. And that's why you see there is a difference in price, right? So if we bought this one at 675 and we sold this one at 617, right? How much would it cost us, right? Well, let's see. We actually could just go ahead and throw this into the risk profile. I'm sorry, vertical cost spread. So I gotta clear out some of these old processes. All right. So another word for debit cost spreads is or vertical cost spreads, right? Um, so as you see, the spread between these two contracts that we were looking at, right? The difference between them is 0.58, which equates to $58. Right? So that's a big difference when it comes to accessibility, right? Let's say we didn't have $700 to spend on this call option, right? But we knew that Amazon was going to skyrocket during this time frame, and we wanted to profit off of this opportunity. We couldn't afford this, right? But we, learned about debit call spreads or vertical call spreads, and we decided to buy this and sell this at the same time. Then this would only cost us $58, right? So it's much more accessible. But let's see how this affects our profit potential versus our risk. Because one thing we do understand when it comes to buying calls, like if we were to simply buy this call right here for a little under $700, one thing that we do understand is that the profit potential is unlimited. Whenever you're buying a call, profit potential is unlimited, right? When it comes to buying call spreads, one of the first things you want to understand is that although you can make a lot of money, although the profit can be substantial, it does have a limit, and that depends on various factors. Um, but we'll go ahead and go back to the one that we have pulled up, right? So what it costs us about $58, right? So what is our expiration date? It's like the 22nd of April. So first thing we want to see is how much would our spreads be worth? Before we even do that, let's look and find out what the max profit potential of the spread is, since we're coming to, know that it does have a limit, right? Well, if you look here, right, the spread that we bought would be buying for $58 a pop. The max profit potential, right, would be 942, which means the spread would be worth 942. That's the most it can be worth, right? So what does that equate to? Well, it equates to a little under 100 grand for every contract, every one of these spreads that you would buy, right? Um, if we go to the 22nd of April and let's say, I just want to put this into the slides. Say it was 3,600. Let's say it was, I'm going to put this there. Let's say it was 3,000. Let's say it was 2,500. And then let's add another one. What if it was 3, 5, 6? All right, I'm gonna put these in order. All right, so if you look down here, all right, this is a tool we've used in all of our past sessions, right? I put in a date of 4/23/2022, right? So expiration date is the 22nd, right? If we put the 22nd, it's going to show us what the scenario would warrant at the beginning of that day, whereas 23rd will show us what our spread is worth at expiration, right? So we can do both, right? So let's say on the 22nd of April, let's say Amazon is trading for $3,600, right? Well, you'll see that our profit would be $720, right? Of course, that would be if it was at this price at the beginning of the day on the 22nd. But once everything expires, that's when you see that our spread would then be worth much more, and our profit potential would be $942, right? Now, let's see if on the on the morning of the 22nd of April, let's say Amazon is trading for $3,500, right? $3,560. Our profit would be $486, right? Whereas if we wait to expiration, it would be worth $942. Sorry if I caused confusion. I think I said like $90,000 earlier. All right, but yes, this is showing our profit, not the price of the spread. All right. So at expiration, let's say it did not close anywhere near our strike price in our prediction. Let's say it was at $3,000 per share. As you see, since it's in parentheses, it's showing our loss. We would lose $58 per contract, right? So you can only lose what you put in, right? Which also applies, which also typically applies when you're trading call options by themselves, right? Buying call options, I mean, you can only lose what you put in. Um, Same thing applies here. It's just that it's typically more accessible. It's much more cheaper and affordable to buy a call and sell a call at the same time because you're not buying either. You're just buying the spread between those prices as a recap. The same thing applies if it's selling for $2,500 on the 23rd of April, right? We would still lose the same amount, right? So risk is still capped, right? But in this scenario where you're doing a debit card spread, the profit potential is capped, right? And that's different than when you're selling, when you're buying calls alone, because when you're buying calls alone, the profit potential is unlimited, right? So, does anybody have any questions about that part of what we just went over? What's up, Rudy? You back? I think you missed a portion of it. Are you were you able to catch up, or are you a little confused coming back in to the session? Okay. So I think what you missed was just this part. So just a quick recap. Just a quick recap because I'm not really sure what 'cause you're the main participator. Um, the analogy I used was that let's say you wanted to buy an orange, right? Let's say that orange cost $1.50, right? Right, and let's say you also wanted to sell an orange, and you were able to get $1 for that orange, right? The difference between this is obviously 50 cent, right? Now, let's say instead of buying an orange, what would cost you $1.50, let's say you don't have $1.50, but you thought the price of oranges was going to go up through the roof for some reason. Maybe there's an orange shortage or something, right? And you want to profit from this, but you didn't have $1.50. Well, what if you could just buy the difference between what you're buying and selling? What would that be? It would only be 50 cents, right? And the same applies to stocks and stock options, right? You think about some of the most expensive options there are. You think of options for Amazon, Google. I guess they're splitting soon. Sorry. Uh, and since these stocks are so expensive, the options for these underlying stocks are also expensive. And we use a scenario, what if you thought Amazon was going to essentially go through the roof over the course of the next 4 weeks, 8 weeks or so, and you wanted to profit off of this prediction? Maybe you're doing your technical analysis and you're seeing a pattern and you're looking at, different things going on in the world, and you're like, Amazon is going to go through the roof, right? But you couldn't afford to buy an option for it, which might cost you $3,000, $15,000, maybe even more, depending on where you buy it, expiration date and strike price. Um, but let's say you also learn about debit card spreads, and you realize that although you don't have $3,000, if you bought an Amazon call for $3,000 and sold an Amazon call at the very same time for $2,900 or $2,989, right? You would realize that the difference is only 11 cents, and essentially you getting a seat at the table would only cost you not 11 cents, but $11, right? So debit card spreads, debit put spreads, one of the main things that make them attractive is that they're more accessible to retail traders, and because they're more cheaper to get a seat at the table, and since and when something is more cheaper to get a seat at the table, also offers you more ways to mitigate your risk, right? Because um, in this scenario, let's say does go through the roof, and the value of this call option goes up to $5,000, and the value of this option goes up to, $4,300, 43 or $4,350. You'll see that the difference would also increase, and your $11 will now be worth $650, right? So the risk will still be capped, right? Um, However, you still would make a lot of profits even though the profit potential is capped. And that's one of the main differences between buying vertical spreads and just buying a put or buying a call. When you're buying a call option, the profit potential is unlimited. But when you're buying a spread, um, profit potential can be significant depending on various factors, but it is limited. So that's the gist of the part that you missed. And I think when you came back in, we had already pulled up the options chain, and basically what it would look like is right. So if we go, we got 22 April 22, right? So if you're looking at these at the money options, right, you obviously see that pretty expensive out this far, about $15,000 just to get a seat at the table, right? But if you go out of the money, or if you just you could do a vertical call for this one, but it wouldn't be as profitable. But if you went out, let's say you thought Amazon actually had a chance of appreciating to $3,600, you come a little bit in here, and you'll see that the strike price, the contract at the strike price of 35.50 would be a little under $700, right? $675, and slightly out of the money, or slightly more out of the money, right? It would be worth $617, right? So if you bought this one, sold this one at the exact same time, it wouldn't cost you $700, or so. It would only cost you the difference, which we put into our risk profile that shows us scenarios, and would only be $58. So it'd be $58 to get a seat at the table, vice almost $700 to get a seat at the table, or even more depending on if you're buying it close to the money. Does that part make more sense? Okay. All right, give me one second. Okay, so I'm gonna pull up the spread. So we talked about calls and puts, and now we talked about call debit spreads, debit call spreads. Um, so let's talk about these puts real quick. All right, so again, a quick recap. When it comes to debit put spreads, it involves buying a put option and selling a put option, right? And the same principles we talked about when we're going over debit call spreads apply to debit put spreads, right? Where you're buying the spread between two contracts vice buying the actual contract by itself. So we can just go into, let's see, what, so so I haven't really been involved with the daily live trading, but I think typically it's day trading. I mean, you can day trade spreads as well, but yeah, I'm not very sure if they've been using that a lot. Um, yeah, yeah, that's typically what I use it for. So if you look at my alerts, I haven't been posting alerts in a while due to my work, working long hours and just being burnt out. Um, but if you look at some of my trades, you will see there was a point in time where some of the stuff I was posting did involve spreads. However, one of the things that, just to piggyback on what you said, is that it is a little complex, right? So when in my experiences, when individuals didn't necessarily understand the components of what make a spread, right? And understand why it moves a certain way that's different than, because when you're buying a call, you're buying a put. Yeah, it's a little bit more complex than but just buying stocks themselves, but once you wrap your head around, the basics, it's pretty simple, right? You notice the stock goes up, and typically the option goes up with it, or vice versa. Whereas when it comes to spreads, they move a different way, right? And when it moves in a way that's not typical to what beginning traders are used to seeing. They freak out and they're like, "Oh man, am I doing it wrong?" And things of that nature. So this course is it can be very beneficial for those looking to get into more accessible ways of trading, right? But you're gonna want to look for, I believe. Let's see. I want to pull up Discord because I think there was another guy who I think he still posts spreads. Let's see. Oh yeah, there's Harry Spreads. Can you see these? All right, let's see what he has here. Oh, he's doing calendar spreads. Let's see. Yeah, so he shows the expiration date, and he sells. He says sell the 265 call. I think it's a, yeah, call, and buy the 267.5 call. Right, and it's $100 credit. Excuse me. Max loss is 150. Let's see. Yeah, so it looks like he posted spreads. I believe there's another guy, Doc. I think he posted some spreads as well. Yeah, so bearish credit spread. Um, yeah, he'll post spreads from time to time, call verticals, and then yeah, I can't remember the last time I actually posted spread. Um, but yeah, there are some individuals that do post spreads. Um, but again, it is a little bit more complex. So hopefully those looking to get involved will do the work to gain more of an understanding. And hopefully this class will kind of facilitate that process. Uh, does that answer your question? Like why you haven't really seen them? Okay. All right. So, put spreads. I think that's where we left off. All right. So we're back at Amazon. All right. Let's say we think that and this is just going to be brief because I mean a lot of the same principles apply. Um, but let's say Amazon is expected to drop a little further, right? And we expect that it may find support somewhere along trend line like this. And let's say that comes down to like $2,500, and we want to profit from this decline in the price, but don't have the money to just buy a put that expires way out here in November or so. Um, so let's see. Let's go with July 29th. We'll put a little oval and put that there. Activate, put that there. All right, so let's go to trade. Let's go to, what was it, July? Yeah, let's go to July 15th. So let's say we think Amazon is going to go down, right? So first thing we're looking on this side for the puts, right? Because calls are here. We're looking for the puts, right? And we were looking at what about $2,500, right? So to go out of the money here, we're going to go up here, and it's 2,500. We can go a little bit closer to the money, and let's say we're looking at these prices. All right, where is the mark? Oh, the mark is way over there. So you'll see that these are rather expensive, right? So the mark over here is showing that costs about $10,000 to get into a put option with a strike price of 25.40, right? $2,540. It goes slightly more out of the money, and it gets a little cheaper, but still costs about $10,000, right? So what if we did a vertical put spread? That would that would involve us buying this put, right, for $10,762, and at the same time selling this put with a strike price of 25.20 for 10,000, a profit of $10,267, right? And doing these things at the same exact time, let's see what that spread will cost, right? So I'm gonna go, I'm right click or double click depending on what type of computer you have, analyze by, by trade, vertical, right? Go down here, I'm gonna unclick call spread that we had up, and then look at what we have here, right? Oh, what did I do? Oh, I did it wrong. So I'm gonna delete this, delete that. Go back. So to this one, analyze by. Why is it giving me the? Alright, gotta go. Okay, now we have the puts. Alright, so I'm gonna close this. Alright, so now we have the puts. Right, so we have the strike price of 220, 25.20, and 25.40. So the spread for this would be 495. All right, so still a little expensive, right? But it's a lot cheaper than about $10,000. So if we were to buy the difference of those two options, which would be um, the strike price of 25.20 and 25.40, it will cost us about $500, right? Now, in order for us to make our max profit potential, of course, at expiration date, that will require the price being below both of these strike prices. That's how we will receive the maximum profit potential. And let's see what the max profit potential would actually be, right? So we go out to July. What's our July 15th? So we go out to July 15th, 16th, right? And let's see. Right. I want to reset these. Reset the slices. Right. So let's say Amazon just tanks to 2,000. Then let's say, what if it tanks to 2,500? Here, let's say it goes down, but it only goes down to like, wait, where's that right now? So it only goes down to 27 here. Um, okay, so as you see, expiration date is 15th of July 2022. I have this set for July 16th, 2022, so we can see the max profit potential or max loss potential, right? So if at expiration date Amazon is trading for $2,000, right? You see, our profit would be $1,500, right? $1,505, which would also be what our profit would be if at expiration Amazon was trading for $2,500, right? So obviously, our max profit potential for this $500 trade would be $1,500. Our maximum risk, right, would be the money that we put in, is $495, right? So again, capped, right, a limit to the profit potential, but it's also a limit to the loss potential. And in addition to that, it offers your accessibility, right? More accessibility, because if we weren't doing both of these transactions at the same time, it would cost about $10,000 to get a seat at the table, right? So let's go back here. Go back here. So we talked about calls and puts, right? um, as far as debit call spreads and debit put spreads. We talked about risk. We talked about profit. We talked about the profit cap. We slightly touched on position sizing, right? But we haven't gone over moderate theta protection. So what do I mean by that, right? Well, more generally speaking, let's see what would be the best thing to pull up. All right, so for those of you who weren't here for part one, that's part two. We talked about basics of premium, right? And one of the things we talked about was time. Excuse me. Right, so time and how the value of an option's premium changes as its time to expiration decreases, right? So the value of an option contract, right? That value changes as its time to expiration decreases, right? The closer we get to expiration, time affects that option contract more, right? And the rate of this change increases as the expiration date nears. Now, whether the value of that contract goes up or down depends on, what type of what type of option you're owning and whether or not you bought or sold said option, right? So the Greek that's responsible for measuring this fluctuation in relation to the underlying stock is called theta, right? This is the Greek responsible for measuring the daily rate by which an options contract's value depreciates or appreciates due to time decay, right? So this is important to understand when you're dealing with options, right? Very important to understand because it affects your decision making as it pertains to how long you want to own, when you want to hold an option, whether or not you want to hold an option at all, and what expiration date you should enter that options contract, right? Um, so let's see. That's not what I'm looking for here. All right, so let's go to. I want to show you a more extreme situation, right? So still looking at Amazon, right? Amazon is selling for about $2,900 as we speak. And let's put in a scenario, all right? Dun, dun, dun. So I'm gonna go back to my chart and change my time frame to something more short term. Wow, Amazon does not look good. All right. So 90-day 4 hour. Wow, that kind of looks like a Head and Shoulders. Rough one though. Or possibly an inverse Head and Shoulders. All right, so let's say we wanted to predict that Amazon was going to find some support. It was going to find buyers, and they were going to step in and push this price up to what's the 20? What's the end of this week? The 11th of March. All right. So let's say that by the 11th of March, we thought Amazon could jump up to. All right, I gotta put the time thing in here. Double click that. Put in this. Put that. All right. So this is what we're looking at now. All right. Let's say we thought Amazon would jump to $3,400. That would be insane, but anything's possible. So let's say we thought Amazon was going to jump up that high, right? All right, so where do we have $3,400? All right, so the first thing I'm going to show you, I'm going to put in, that's fine. So we're thinking 3,400, but I'm going to find a strike price slightly below that, something like 33.70, right? As you see, these are very cheap, right? Because what are the odds of Amazon um, appreciating by this amount within 7 days, 5 days, right? So it would only cost what, $35 to buy this option contract. So I'm gonna put buy trade in here, single, right? Close this one, right? I'm gonna unclick this one because I also want to put in a spread into the scenario as well and compare price fluctuations as time to expiration decreases. All right, so for the spread, let's put something like 33.80 and 33.90, right? So one will cost 34, the other one will cost 32. The spread of this would be only 2 cents, well, $2. So, oh, hopefully I clicked it correctly. All right, so as you see, the spread between these two options, 33.80 and the 33.90 strikes, is only $2, right? Very accessible, very cheap, right? Um, First thing you want to look at, let's throw in some crazy scenarios and change the date. Or just reset the dates and parameters, and then let's go ahead and put in let's start with the 12th. Come on. All right, 12th. All right, so if we owned this options contract, let's see, and let's say the option contract, say the options, I'll put these in order real quick. All right, let's say we bought a call option, a single call option with a strike price of 33.70 that expires this upcoming Friday, the 11th of March, right? And it only costs us $52 for one contract, right? Let's say Amazon went crazy and then So much that by the end of the week, Amazon was trading for $3,600. Right. Well, as you see, our profits would be upwards of $20,000, and our profit potential in this scenario would be unlimited if Amazon chose to go up even higher. Right. You see this? It just keeps on going higher. If it was 3,400 by the end of the week, right, our $52 would net us a profit of almost $3,000. If Amazon traded for $3,000 at the end of it, we would lose all of that $52, right? Then we show it with the vertical spread, right? That $2 that we put in if Amazon did go crazy. Um, the max profit we would net would be uh, about $1,000, right? Which still would be very, very significant, even more significant percentage wise, because we would have only put in $2. And that would be our max, and then our max loss would be $2, right? All right, so now let's look at the differences in fluctuation when it comes to theta. All right, so let's say, all right, so it's 11. Let's say that halfway through the week, actually, yeah, let's say like halfway through the week, um, we owned this single contract that we paid $52 for, and let's go back and reset these price slices. All right. And actually, let's start with Monday, right? All right, let's say Amazon jumped 10%, right, tomorrow, right? We own the single contract with strike price of 33.70, right? So the contract would not yet have been in the money yet, right? It would still have some time, however, right? So profits would be about $2,000, right? And let's say if it stayed at this price, right, 31.98, 10% higher, by the next day, you see a profit would be down about $600, right? And then let's say it stayed at that price on the ninth, it was still that price. You see our profit would now be down below $1,000. And let's say it stayed at that price on the 10th, and our profits would be down to slightly below $400. Let's say we were still holding this on the beginning, in the early morning, on the 11th, our profit would only be about $21. And if we held it to expiration, it would turn into a loss of the entire $52 you put into buying this outer money call, right? And of course, it would be worthless because the strike price is 33.70, and in this scenario, although Amazon would have gone up a significant amount, it would still be not high enough, right? It still would be below the strike price, all right? So that's how that looks. Now let's compare that to um, what the fluctuations will look like if we had this spread, and you'll see it'll be a little different. Um, 30 cents, like 7. All right, so this is tomorrow. All right, see Amazon. Say Amazon goes up 10% tomorrow, right? Our $2, our $2 trade would be netting us about $100. So right off the back, you can see that the percentage wise profit would be much more substantial, right? $2 to $100 plus would be pretty substantial. Um, and then we go a day forward to the 8th, right? and it would be a little under $100, right? And then go to the ninth, it would be about $73 in profit from a $2 trade, right? And on the 10th, $45 from a $2 trade. Still, at this point, it's still very significant, right? You're talking about 45 divided by 2. The profits are still very high, right? You go to the 11th, and even on the day of the expiration, right? That early morning, our profits will still be, what's that, 500% plus, right? And at this point, the stock price still would not have been in the money. However, on the 12th, of course, our vertical spread would be worthless because, of course, the price would not have been high enough. Somebody's blowing up my. Okay, something else. All right, so right at the back, you can see that there was some theta protection here, right? With the vertical spread, we maintained very significant profits even up to that very last day, right? Whereas when it came to holding this single call, those profits were heavily diminished every day that went by. In fact, on the day of, in this scenario, our single contract, if we would have gone that route, would be only at a profit of about $21, right? So it's about 40% profit. It's not bad, but you compare that to the day of an event that we had this vertical call spread, um, that would be upwards of 500%, even on the day of with something that's still out of the money, right? So there's a million ways you could play around with this if you so chose. Um, my tool of option is Thinkorswim platform, of course, Analyze tool, which you could use through just double clicking whatever you're doing, whatever you're looking at in the options chain, going to Analyze, going to buy trade or sell trade, depending on what you're doing, picking whatever option uh, combination you're looking for, single, vertical, etc. And then that just pops it into the risk profile tool. And you can play around with different scenarios to calculate your risk and profit potential. Um, and yeah, that is, let's see what we got. So yeah, that's what I mean when I put in moderate theta protection. In the scenario we used, I would say that was significant theta protection. And why is that? Well, because if we go back, right? So if you notice, I guess the best way to illustrate this would be to show the call that we would be selling as a part of this vertical call, and that would be the 3390. So let me show you guys that real quick before we wrap it up. So we got the 3390 when we sold when we were selling that. So we go buy trade. Oops. So go here, analyze sell trade, right? Single. So now it's showing us a scenario for us selling the 3390, right? In the vertical put, right, we were buying the 3380 and selling the 3390, right? So now we want to get some more insights into why the theta protection was so much more different than what we saw when we were holding the single option contract. And to understand that, you got to understand how theta affects your position if you sold a call, right? Because if you're buying a call, each day you get closer to expiration, the value of your call does what? It goes down, right? But is that the case when you've sold a call? Each day that gets closer to expiration, is the value of your position going down or is it going up, right? So let's see if we can illustrate that here. So here, all right, we have oh yeah, that's weird. All right, so here we have on the 7th, right, it's showing a loss of 1730, right? And I guess that is because at this point we're talking about a naked put. So, but we won't go too much into that. We just want to see how things move as the days go by, right? So, um, if Amazon was at $2,600, you see the profit would be this. If Amazon was up 10%, the loss would be that. But as you go further, you'll see the loss here goes down, right? And right, the profit here is already capped, right? But as you see, your position, right? Um, your position appreciates in value the closer you get to expiration, right? And this is if you're just selling this call, right? On the 7th, right, you see you had a profit of this if Amazon does this, right? But if it's up this on the 7th, 10%, right, you're down that much. But every day that goes by, right, it's $500 your account goes up by, right? That's another, right? It's another few hundred. It's another few hundred, right? So when you're doing this vertical call spread, although the call part of it that you bought, the part of this vertical spread that involves what you purchase, right? Although that value goes down as days near expiration, the value of the part of the vertical call where you sold a call that goes up. So you get a moderate to significant theta protection because both of those forces are essentially offsetting each other. So it becomes, in a sense, can become less risky to hold a position if you are in a debit call, debit put position than it does if you're in a single, call position that like you bought a call, you bought a put. It becomes, more risky to hold those things if you're doing the latter. Any questions about that before we start doing a recap? Oh yeah, awesome. Okay, let's see where we're at. Okay. Um, if there's no questions, I think we did go over each part of these. We didn't really get time to go into how things change when you're comparing in the money versus out of the money um, debit debit spreads. But if you were here for last session, you can pretty much apply those same principles here when it comes to debit call spreads. Some of these topics, right? Um, Overall option strategies and different factors, you guys want to be familiar with some more than others. Um, we can go over those in our next session, which will be Stock Options 101 Part 4. Date to be determined. Um, but I would expect for it to be next Sunday. We'll just get that confirmed. Um, Thanks, guys. If there's no questions, I'm going to wrap things up, and I hope all of you guys have a great weekend. Any questions before I go? Yeah, no problem, James. Thanks for uh, thanks for joining. All right, guys. I hope you guys have a great rest of your Sunday. Hopefully, you guys, got some good rest and recharge before this next week. And I hope your week is going to be as crazy as mine. I'm looking forward to getting back into trading and posting for you guys. Unfortunately, with the things going on in the world right now, that has affected my work schedule in the military. So to be determined, but I do enjoy these opportunities to get here and to get online and help you guys understand some of the things you guys are trying to learn. Yeah, so I'm gonna go ahead and head out. You guys take care.